session this afternoon. But please just remember that the speakers that are here are just here to guide the conversation. Feel free to join in the conversation. If you also have comments, join in the conversation. If you have questions, please post those questions for us as well. So you can use the chat box to post your questions and your comments. And if you want to maybe voice your questions and comments, then you can just raise your hand and our technical team will unmute you and then we can just give you the platform. We're not going to reserve questions for the end of the session. We'll just allow everybody to ask questions as and when we go along, and then we will just monitor and field them from there. So just a reminder that if you have anything to say, you can just drop it in the comment box. Thank you. There, SiMODiSA startup, they will be facilitating the questions and keeping an eye on the questions. So just before we get into, or just before we start with the conversation, let me remind you and request that you also keep the conversation going on social media. Tag us on Twitter. Our account is @SA_StartupAct. And on Facebook, SA Startup Act Movement, and use the hashtag SA Startup Act Movement. We will also drop these accounts in the chat box and the hashtag. Please let's use the hashtag so that we can, it makes it easier for us to pick up the comments and the conversation. So in today's webinar, we are discussing one of the recommendations that was made by the SA Startup Act Movement, and that is to incentivize, incentives to encourage investment in early stage startups. So incentivizing investors to invest in startups. And to set the tone and to also give us more insights on this topic, we've got Shelley Lotz, who is the Head of Regulation Affairs at the Southern African Venture Capital and Private Equity Association, SAVCA. We've also got Tafadzwa Madavo from Riversands Hub. He's the CEO. And finally, we've got Keet, who is the co-founder and partner at Knife Capital. So Keet, Shelley, and Tafadzwa, thank you very much for your time and welcome to the webinar.
Thanks, Tumi.
Thanks, Tumi.
Thanks. Look forward to it.
Great. So let's just set the scene, and just for those who may not be clear on what the Startup Act movement is about and why there's actually a Startup Act movement in South Africa. Perhaps, Shelley, as you've been one of the members of the steering committee for the SA Startup Act movement, perhaps you can just introduce us to the movement, what it is that you're driving, and also give us a brief introduction to this recommendation that you made in your position paper.
Thanks, Tumi, and good afternoon, everyone, and thanks so much for having me. So the SA Startup Movement is really a collection of people and organizations that believe as a country we actually need regulation and policy reforms as it relates to high impact and high growth startups. And really what we're looking for is that to lead to economic growth, improved global competitiveness, as well as increased innovation in the economy. And that's really what this is all about. And as we think about what the recommendations are, the one that we're going to talk about today is really looking at how do we get more capital, risk capital into startups. And fundamentally in South Africa, we actually have such a big shortage of risk capital to invest in these types of organizations. So just to set it out, we're not saying that there shouldn't be policy reforms and there shouldn't be specific attention as it relates to investment into SMEs. We definitely think that. But the SA Startup Movement is specifically focused on startups. And actually, because they've been shown to really disproportionately create jobs and economic growth. If South Africa wants to be successful as a country, and it's really the bedrock that we need to be able to have to stimulate that economic growth. And that's really what we're going to talk about today. And if you look at it from an investor perspective, when they look to invest in a company, it's a risk return profile. And where we talk about risk capital, they need to be able to be compensated for the risk that they take. And if they feel like they're taking quite a large risk, then there isn't actually a lot of investors that are willing to take that risk. They understand what it means, etc. So what we're talking about today is really what incentives can we put in place in order to get capital to flow to this very important segment of the market. And that's what we're there to talk about.
You're on mute, Tumi.
Thank you, Shelley. Thank you for getting that I'm on mute. Yeah, so thank you for that introduction. And if you haven't learned or heard about the Startup Act movement, please visit their website. It's www.startupact.co.za, and you'll be able to download the position paper and find out more on what the movement is calling for, policy reform, and also introducing certain incentives that will actually help the startup ecosystem grow. So your support of the Startup Act movement is highly, highly recommended and welcome. So I'll ask you, Keet, since you are venture capitalist, well, Knife Capital is a venture capital company. Maybe give us a brief overview on what the venture capital landscape looks like in South Africa, and what is it that we can perhaps learn from other VCs globally?
Sure, thanks for that. I think, yeah, firstly, there's a lot to learn from and a lot of incentives and things we can copy from other ecosystems. So we don't have to necessarily reinvent the wheel for some of the incentives that we're talking about here. But at the same time, we also need to really find our own heartbeat as an ecosystem. Like, what are our core differentiating factors? What makes us so special? I really believe the South African startup ecosystem and entrepreneurs behind it have some form of tenacity, really building challenges or building solutions to challenges that matter, and whether it's been health tech or fintech or ed tech, etc. So I think from that perspective, we really, it's all about building meaningful businesses and enable them to grow. And ultimately, funding is just one enabler. And unfortunately, for two, or maybe there's a third reason, and many others, but three main reasons, that our ecosystem does not really operate in a full functioning way like it should. And firstly, is that we don't really have government programs that back high growth early stage startups, and there's many reasons for this. We have a very complex ecosystem when it comes to SMEs, to small businesses. So we by no means saying that startups are the only thing that matters. There's many other verticals of entrepreneurship that matter. But as I think Shelley pointed out, it is proven that high growth businesses are the multiplier effect on job creation, innovation, and ultimate economic growth that pay tax and put it back into the ecosystem. So we have to back this ecosystem. Okay, so it's maybe not all on government shoulders. So where's the private sector in this? Now, unfortunately, venture capital firms like Knife Capital and the many other great ones out there, Glycani, 4DI Capital, Digital Africa Ventures, and et cetera, are need to get their capital from somewhere, and for some reason, and not to go into that today, the institutional capital does not follow venture capital in South Africa. So the big pension funds and the institutional funders who sit with a lot of money are more backing the safer bets, in inverted commas, like the asset classes which are more traditional, like stocks and bonds and property and listed companies. So their capital does not actually filter through to the startups. And I think then the third sort of reason is our ecosystem is not as layered, meaning there's not different layers of funding that startups can access, early stage funding, pre-seed funding, then raise Series A, then raise Series B. And I'm maybe getting a bit too technical, But if you throw this all in a pot, it really means that we have a market failure at the earlier stages of startup growth. Your question is more specific around where's the venture ecosystem. Like more and more venture capital businesses have come through the woodwork. International companies are interested. The SASME fund did wonders, and within 2 years or 3 years became the biggest funder with 1.3 billion rand to them via the corporates, identifying this gap. But that's not enough, and all of that is funding more businesses with traction. So if there are any entrepreneurs in this group, you would have unfortunately heard the following sentence. It's like, love the business, love the team, love the product. The market opportunity is there. If only you had more traction, then I could invest, and I think that's the problem, is how do we get businesses with enough traction, meaning to their first clients and so forth with, and that's what the Startup Act is trying to do. And specifically, if to just make the problem a little bit more complex, specifically if we really targeting Black-owned businesses, which we all are doing, then it becomes even more difficult to find that first 100,000 rand, that first 1 million rand, that first 5 million rand. And these are small numbers in business terms, but big numbers for individual startups that don't have that startup capital. And this is exactly what we're trying to address, that market failure, making it easier for startups to get that capital.
Yeah, you raised very important points there, Keet. And I just want to also put it to those of you who are attending. If you're an entrepreneur, you are a startup, early stage startup, maybe share with us some of the challenges that you've had. Have you also heard that dreaded sentence that Keet spoke about? Unfortunately, you don't have enough traction. Just let us know in the comments, and what do you think should be done? I think part of having such webinars is not just to speak about the challenges and complain and just have a talk shop, but we just need to use these platforms to come up with solutions and to present those solutions to the relevant people, but present them as a collective. That's part of the reasons why the Startup Act movement was formed, because listening to just one part of the ecosystem does not make an impact. If SiMODiSA on its own were to go to government, or if SAVCA, well, SAVCA represents an industry, but let me just say, if Knife Capital were to go to government on its own, it doesn't make an impact as much as if us as an ecosystem rally together and we approach the relevant policymakers. So it's very important that we get your views, your opinions. So please feel free to give us your experiences and drop those in the chat box. Tafadzwa, I want to now come to you as an incubator, accelerator. Talk to us about how you guys assist startups in becoming investor ready, and paint a picture for us of some of the challenges that startups experience when raising funding.
Well, thanks to me. So us at Riversands, firstly, I think just to clarify, we have noticed that there are two distinct tracks between your normal typical small business and your startup innovation underpinning, right? And so the first thing we've realized is that we actually have to develop both. So we've been predominantly at this point in time focusing on your small business. And we're now at the early stages of establishing a track that speaks to more the startups, right? Because the DNA and the entrepreneurial journey that is undertaken by startups, especially those underpinned by innovation, is very different from your typical startup. That's not to say that both are not important. Both are important, especially for looking at economic development and economic participation. But I think speaking about the challenges, I think Keet highlighted, quite a number of them already. I think at the forefront would probably be access to capital, right? We've got a lot of these programs that are being run. One, obviously, because we haven't fully mastered the startup innovation space, they tend to lean more towards the SME, small business space, right? And because the tracks are very different, Keet mentioned early stage, seed, all these rounds are things that we haven't actually fully comprehended, and how to actually structure incubation programs or programming in general that speaks to that, right? I think key to that is the element of transitioning from just knowledge sharing, which is predominantly the focus, to commercialization. This is where capital comes in, right? And you notice a lot of the time with the SMEs, they struggle to access capital. It's already difficult as it is because typically a startup would be reliant on, let's say, friends and family, and then transitions to then being able to attract some form of finance. A lot of the time with a startup, it's leaning more towards, let's say, equity as opposed to debt, in my view. And it's very difficult, especially we don't have the social capital. A lot of people don't have it. And the programs are not necessarily configured in a way that speaks to the needs of those particular startups. Keet was very right. Traction is something that we hear a lot of. We, as a result, actually started our own fund, which is a more debt fund, to try and address the challenges that we were seeing within our small ecosystem. And that is your purchase order funding, working capital, asset financing. But we were now, as we were speaking around, okay, let's see if we can do something for startups. We are now trying to figure out, oh, look, we can have a program, but at the end of the program, we need capital, right? And we're realizing the problem that you have is that being able to access that capital as an intermediary is also very difficult, right? We may be more established, we may be a lot more visible, we may have all these structures, but even for us to start, let's say, a VC fund that is good, putting in some level of equity and trying to fund some of these businesses is extremely difficult. Now you can only imagine the challenges that a lot of these businesses then face as a result. What then happens is that a lot of them go through programs and then are stagnant in some point, right? They can't go any further because they're not able to get capital. And even if they are able to get capital, one of the things we've noticed is that the capital is not sufficient. When it comes to startups, the DNA is very different. You're investing a lot more in growth, right, and innovation, which requires a substantial amount of capital. Now, your traditional sources of capital, like financing and debt, may not necessarily be appropriate because a lot of the time, maybe you're pre-revenue, for example, right? And so you're not necessarily making profit. And so for you to go to, let's say, a bank and say, I need a loan, they are very unlikely to give you anything. So it puts a lot of these startups in a very catch-22 situation. And when we're now trying to figure out how do we actually build the ecosystem and the track that speaks to startups, we are noticing capital. In the absence of capital, all we're doing is knowledge sharing. And to be honest, in this day and age, knowledge is in abundance. You can go online and get it. I mean, if you really want to. Capital is what will catalyze the growth. Capital is what would help these guys transition from, let's say, early stage seed to go to Series A, Series B. And we would really want to see a lot more of that.
Great, thank you, Tef. And I think just before you mute yourself, can you maybe explain to us, you started off very well by explaining the difference between the startup and the SME, but maybe a qualifying startup, maybe what that is, so that those who are not sure have the clarity.
So it tends to be very contentious, but let me give it a try, right? Let me give it a try. So startups in this, the way I see them, is there's an underpinning of innovation. And a lot of the time, technology is associated with that, right? From a strategic perspective, a lot of the time, the focus in terms of priority is not necessarily profit. As opposed to a small business, from the onset, you're trying to get profit. The focus is on growth, right? And growth in terms of the number of customers, exponential growth. So you're looking at scaling and having the potential to probably even look at a global scale in terms of the market that you're trying to address. And so the innovation will fuel that. So you're also trying to disrupt the market, right? You're not necessarily looking at replicating existing models. Because you're looking at a scaled model, there's tech and innovation in there. You're looking at disrupting a market, attaining growth in terms of, let's say, revenue as opposed to profit, which then inherently means that you're different. Examples, for example, are like your Netflix, your Ubers, for example, which at the very early stages were not profitable. And a lot of people were confused as, okay, so are they a business? But you have to understand their long-term strategy over time. This is also why when it comes to their entrepreneurial journey in terms of getting capital, raising capital, they lean more towards, let's say, equity right? Because debt is very difficult. Like I said, you're pre-seed, you're focusing on, let's say, innovation. Profit is not a focus. So it's very difficult for you to even look at debt as an option. So equity is an option. Now, equity, what they're looking at is VCs would invest in your business. But what they're looking for is within a particular time horizon, there is an upside in terms of your valuation. So look, I don't want to get technical, right? But there are a number of different facets that make it different. And I think the key fact is there's an element of innovation, technology, exponential growth with the potential of actually addressing a market globally and disrupting a market. If you're looking at that from a strategic perspective, then in my view, you're a qualifying startup.
Thank you very much, Taf. A lot of people in the ecosystem don't call you by your full name, right? Do you just
No, I'm happy with Taf. I'm happy with Taf.
Okay.
I was confused when you called me the full name the first time.
Yes, you're like, she's being formal, very formal. Let me just welcome those who just joined the session. We are talking about incentives to encourage investments in startups. And this is part of a series of webinars hosted by the South African Startup Act Movement, or SA Startup Act Movement as it is on social media. So welcome, and you've just caught us as we've just been unpacking what it looks like, the situation that we are currently in now. Now, Shelley, I want to throw this question to you. The SA Startup Act Movement proposes special tax dispensations for qualifying startups so as to increase availability of financial capital. I think maybe this recommendation might get a bit of pushback from the government. I don't know, maybe you can expand a little bit more on that, but also maybe expand on what measures can we put in place to reaffirm the government and reduce tax abuse by startups and others.
Thanks, Tumi. So I think when we look at the incentive, it's very important. So Keet spoke about the venture capital market, for example. And when we talk about investors that are looking to actually invest into these types of startups, so SAVCA does an annual survey. And the last survey that we did, so we're due to release the next one in the next month, but based on the last year's one. So in the 2020 calendar year, the investment in South Africa was 1.39 billion that was invested into 122 early stage companies, not startups specifically, early stage. And then startups would be a subset of that. And the total size of the VC market in South Africa is about 6.9 billion, okay? And that's made up of about 841 deals. So that's as it stands at the moment. And the interesting part about that is when you compare it to the international venture capital market or the global one, which is sitting at about $643 billion at the end of 2021. There's really a big discrepancy. So the point being is that there is capital globally. There's probably limited in South Africa that's going into these types of businesses. So the first question is, the capital does exist. As Keet mentioned, there's pension funds or there's institutional investors that potentially put their money into these types of entities, but you're going to need to incentivize them. And I think that is exactly the point, is that if the private capital was going to go there, it would have gone there already. It needs a little nudge. And maybe that nudge is a form of risk sharing, or it is reducing its risk so that investors can get comfortable with what they're investing in. And ideally, you can do that through incentives. So that's where you're looking at the government helping to really reduce the risk for a commercial investor. And by doing that, you catalyze a lot more investment into this part of the economy than you would otherwise have done if you just rely either on government investing or on the private sector. So really what you're trying to do is to say, okay, well, we've actually got this market failure and we know that there's not enough capital flows into these types of companies. How do you do that? But what we found is that you have to be exceptionally specific as to how do you craft these incentives? What does it need to look like? So the idea that you need to be very specific about the types of businesses that you go into. So we spoke about how would you define a startup, for example, and again, everybody's got a different view and it can be contentious, 100%, but we have to have a stab to say, okay, it's a small subset of businesses that we really want to target. And the reason that you need to do that is the minute that you leave it very wide, then people are going to invest in companies where potentially it's not risk capital, or normal commercial funding would go there anyway, and then it creates a problem, and that's effectively where abuse can come in. So what needs to happen is identifying the types of companies you're talking about and making that incentive, or how you draft that incentive, very, very specific, so that actually it caters for why you're putting the money in there, and that'll actually go to the companies that you're looking to raise the capital for. And I think that's the best lessons learned in terms of what we could do better going forward.
Yeah, thank you, Shelley, for that clarity. I just want to acknowledge some comments in the chat box. I've got Kabo Nguni. Sorry if I didn't pronounce it correctly. Yes, we have definitely had this challenge on our side. If we could get support to get us to the traction needed to enable us to get funding, would assist a lot. Most funders do not offer support. Okay, thank you very much for that, Kabo. Desire also says funding and mentorship. Funding and mentorship and support platforms will be great, as I have the technical skill, but not business management. Okay, thank you. Ravini Moodley has a question. What have we learned from Section 12J investment companies? I want to maybe ask you, Shelley, to comment on that, but if Keet and Taf, if you guys want to comment, please do so.
So I'll start off. You'll go for it, Keet. Hey, no, you can start.
I'm interested in your views on 12J. So, but having been running 2 12Js, I have some opinions. So maybe it's better that you start.
Sure. So from my perspective, the incentive and the fact that a tax incentive was offered definitely catalyzed capital. So I don't think anybody doubted the fact that, I guess maybe let me take a step back. When it was initially drafted, they didn't get the drafting right, and the requirements were probably not too stringent, but didn't work for the commercial sector, and then capital didn't flow. But once they tweaked it to actually be a bit more realistic about how things work in practice and what it did, capital genuinely flowed, and actually it was, we talk about this funding gap that existed. We started inching towards closing it. It's a long process to be able to close a funding gap, but it definitely was moving in the right direction, and we could see it based on the capital flows. So where potentially I could say that we could do better was it didn't all go to where the government, I think, intended it to go. So again, how would we have crafted the definition of a startup? It wasn't necessarily like that. It was more like you can invest in the companies that don't do this, and those sorts of things. And the idea that actually you need to be so specific, even if your definitions need to be, a few pages long, or at least very specific about where it can go, that would have made a huge difference. Because then when it came up for reassessment, the government looked at it and said, or National Treasury looked at it and said, well, is it doing what we wanted it to do? So again, I think the private sector thought, well, as long as you're creating jobs and you're creating some sort of economic growth, that's doing what we thought what the private sector thought the government wanted. But again, that connection between what they specifically envisaged and what actually happened wasn't a close enough link for them to be able to say, okay, we're looking at extending it. So they obviously said, no, we're not going to extend it. Where they potentially could have missed an opportunity is to take something that essentially was already created a capital flow and just narrow down those definitions, or make it much more specific as to, okay, you're based on the way it's drafted now, you can invest in a company that owns machineries. That's not really where we were looking for it to go. It needs to be in high growth, high impact startups, and this is the new definition of that, and then you can channel the flows that way. So, Keet, I'll hand over to you, but that's my take on the lessons.
Yeah, and if I can run with that, those are the lessons that we brought into the Startup Act position paper to say, well, let's define a qualifying startup very narrowly, so that money flowing to this kind of company has certain incentives for that company in terms of where the money goes, in terms of research and development, the type of growth rates, the age of the business, the size of the business, and really trying to narrow that down. I think the second thing is, what have we learned around the venture capital companies, which is also one of the recommendations in the Startup Act position paper, is really how do we create those tax incentives or the incentives for investors that invest in qualifying businesses that have the knowledge and the teams and the skills to then do the due diligences and on investors' money. What have we learned about that tax break in terms of the length of the period and whatever? For government, it was very important to create jobs. So as we say, at the end of the day, you want to create jobs. And I think the thing we've also learned is it takes time. You can't do a measurement and say, okay, well, you've invested R1 billion last year. How many jobs did you create last year? It's like, well, hang on. I mean, in a venture capital game, you invest R1 billion, and then you still have to create the R&D, create employee number 2, employee number 3, and over time, over the next 3 years, there's a lag between the measurement date of job creation and the investment date of when the investment went in. And I don't think that market education was fully understood. Certainly not when we did our surveys in terms of how the 12J things. But I mean, look, it was such a theoretically great incentive. It really catalyzed many VC funds doing some of the right things, and there's 15, 16 portfolio companies on our logos on our wall here, which ranges from edtech to artificial intelligence to HR tech to fintech, that would not have had capital if it wasn't for 12J. So I think it's a pity. But look, there were cracks there. I mean, it was a 12-year experiment. I just hope we can take the good out of it forward and leave the bad taste that it had. The last thing I just want to say about that is, when we talk about tax incentives and why does people need to incentivize, because the simple question that the capitalistic or private sector would ask, well, if this asset class was so fantastic, why would you need to be incentivized to invest in it? What do other countries do? Well, other countries do. The US, the UK, Israel, Kenya, Tunisia, Egypt, you name them, have really adopted this thing. Taf talked about risk capital. So it is really risky for an investor to invest in a very early stage startup, specifically in a market like ours, as I pointed out in the beginning of the talk, which are not as layered in terms of different funding instruments and different things, because there's no, if you do a loan, if a bank does a home loan and so people don't pay the home loan back, well, they still got the asset, the home or the car or the whatever. If Knife Capital invests in a startup and the startup doesn't work, well, it depends. If it could be usually it's for market adoption or lack of market adoption. So we underestimated altogether in the due diligence on the actual solution that this provides and what the price point is going to be and how this is going to work. And, these things happen. Not all the startups are going to work. So therefore, you lose a bit of money on that startup. But then the other one, the market adoption is really fast. So on a portfolio basis, the returns need to be good. But the VC industry in South Africa, because of the fact of lack of institutional capital and those type of things, are still fairly nascent, So people are looking at doing a due diligence on the industry, saying, okay, show me the returns and the success stories of the successful venture capital businesses. And that really is what we need to seed as well, is to say, well, let's try and make this over the next 10, 20 years a viable asset class, so that every asset manager looks at this as an alternative asset and say, well, I have to be in that space. And it's already a little bit turning. I mean, 3-4 years ago, there were no institutional capital in the space. Knife's been raising funding since we started in the 1st of July in 2010. Took us 6-7 years to get the first institutional capital brand, which was from Skybound Capital. Standard Bank is starting to really go into the space. The Mineworkers Investment Company is coming into the space. And they've launched their own Kulisani fund, which is focused on Black-owned startups and scale-ups. And then that then helps to bring development funders into Africa, because we also into South Africa, sorry, because Africa has a great development funding cycle, but South Africa is almost too developed. I mean, we face the thing, but hang on, there's all these amazing asset managers in South Africa. Surely you don't have a market failure. So it's almost like we're fighting the battles on all fronts. So the point of incentives is to de-risk that slightly for the investor, to say, okay, well, hang on, if I invest in companies that are earlier stage, or I invest in intermediaries that invest in those companies, at least I'm a little bit hedged on downside protection. So therefore, it makes my risk return probability a little bit more worth it, because I'm a little bit protected on the downside. Then if the startup gets in tax breaks or R&D grants or some things that come out of the fiscus, the fiscus is also not here to lose money and just give money into an asset class that the whole point of the exercise is, well, guess what? These companies are going to grow. They're going to become the next Discovery Health. They're going to become the employers and the taxpayers. So you just have to almost invest some taxpayer money into future returns of taxpayer money. And if we can just make people understand that flywheel, then that is what we're talking about.
So it's a win-win for everyone. The government wins, the startups win, and when we know that startups in South Africa, they create more employment. So if they win, then the rest of us wins. So let's speak more practical steps now. How should these incentives be managed? And I'm going to throw it to all three of you, and maybe you can give your suggestions. But Shelley, also at the end, maybe I'll start with Taf, then go to Keet, and then at the end you can round off as a movement, as a Startup Act movement. How are you guys proposing that these incentives should be managed? And also we're picking up from the question about the lessons from 12J and all of that, things we've had incentives before, but how can we best manage them?
Okay, look, I think just to follow through on what Keet had said, I think the fact that we are actually having this conversation is already progress in itself. I mean, for someone who's been in the space for quite some time, more on the SME, small business side, this was not something that we actually looked at from a strategic perspective. So I think we are making progress. Yes, there may be other countries that may be, to a degree, probably a little ahead, but I think the fact that we're having these conversations is a positive. And the fact that 12J was there in existence as a start, as a point of reference, I think is a positive thing. And I think we can learn lessons, and we have somewhere to start from. I think from a practical perspective, I think we first need to acknowledge the fact that there are two tracks, right? And that at the end of the day, we need to find ways of leveraging those two tracks as a means to enhance the level of economic growth and economic participation. So acknowledgement is first and important, and I think that's already been achieved to a degree. I think the other thing, especially when it comes to things such as your tax breaks, trying to structure them in such a way that it speaks to the socioeconomic objectives of government. So, for example, one of the ideas I had in my head was, is there a way of scaling or putting scaled brackets when it comes to tax breaks for startups and VCs as well, that it would then incentivize them not only to look at the sector in general, but align the policy to the existing policy, which is more aligned to socioeconomic growth and so economic participation in general, inclusive economic participation. I think it's important for us to leverage off existing legislation as opposed to trying to create something totally new, because it will eradicate the concept of having to go through all the red tape that comes with new policy and figuring out how it works. I think the other aspect is probably, and this is probably on the high end, if we were to create an institution or some form of an organization that is aligned to government, that looks at the efficient execution of those particular incentives, right? And that would call towards, let's say, private-public partnerships, and then aligning, let's say, incentives that will ensure that money comes in and then the social objectives are met, and then the commercial objectives are met at the same time. I think if we were to do that, we are more likely to succeed in terms of actually getting the policy to be there in place, and to also ensure that the policies actually achieve the objectives that we seek to achieve. Again, it's also because the time horizons when it comes to startups and innovation generally are relatively long in comparison to other instruments that are there. And so I think aligning them to the socioeconomic objectives of government would be a good thing at a very high level. That's me.
Thanks, Taf. Keet, Shelley, do you want to jump in? Keet, do you want to jump in, or should I just take it to Shelley? I think let me just take it to Shelley and then go into.
I was going to jump in.
Okay, all right.
Yeah, just following in practically. So you know what we're proposing from a collective around the Startup Act is just to work with the things that are already there. You know, the big companies make it easy for startups that qualify to register for pay as you earn, for VAT, you know, and those type of things. And then, you know, use those instruments which already are there so that companies can actually reinvest their VAT and their pay as you earn and stuff that they're going to pay legally. Because I can tell you from someone who's done many due diligence in startups as well, you know, come end of the month, salaries, the wolves are at the door, and they find themselves in a negative cycle. So maybe just work with what's already there. I know this money belongs to government, but first let the companies kind of earn it and then reinvest it maybe, or partially, or whatever. So that's what we're saying practically. You know, when it comes to investors investing in a business, remember this is capital because it's equity funding. And then at the end of this thing, when you go to a very difficult thing, which is an exit or selling your business, well, then you're paying capital gains tax, you know, and yes, that is due to companies, but just what we're saying is work with those things to make some of these things, if they qualify and like they do in other countries and have survived for more than 3 years and maybe have employed a certain amount of people, etc. Then make way with the capital gains tax so that the investor actually kind of wins at the end of the day. So there needs to be this sort of carrot approach to make and not this stick approach to actually make it very difficult to invest in these businesses, to say, well, look, let's design incentives that produce the desired outcomes, and let's acknowledge that it's going to take a long integrated strategy to get to those outcomes, but those are the practical things, you know. And then maybe, you know, something that just I think we've also learned is it's very difficult for the individual, especially new fund managers without track record and so forth, to go to a big pension fund and pitch for funding. You know, it's better to and those capital allocators also don't necessarily have the skill to do a due diligence on a venture team. You know, like what skills do you have to have other than be totally crazy to be a venture capitalist? You know, how do you look at that? So look at institutions like the SA SME Fund, or create institutions that work with funds of funds, you know, that can actually have a portfolio approach, put mandates in place like the SA SME Fund has, 51% Black-owned businesses, etc. You know, like design something that works for South Africa, that works with the current system, and create the outcomes we all want, which is very, very clear, and that everyone in this ecosystem want the same thing. We want more earlier stage business at the seed level and pre-seed level to get funded. We want those, and if we can get that right, naturally, there will be more Black-owned businesses that get funded, because that's where the Black-owned businesses are. The problem is they don't get funded at seed phase, so it's difficult to fund them at later stage phase. But like, and make sure one does that, and ultimately to make innovation, job creation, and economic growth happen, and make this a viable asset class, so that the private sector said, hang on, if I want to have outsized returns, I better back these innovation-driven venture capital businesses with a healthy slice of my portfolio, you know, and just like we do in other ecosystems.
Great, I agree with you. Lerato says, love it. As Charlie Manga says, show me the incentives and I'll show you the outcome. Thank you, Lerato. Shelley, before I come back to you there, I just want to read a few of the comments there. Advocate Adams says, is it maybe that SA investors are highly risk averse as opposed to our Western counterparts, including the government? So that's a question and something that we could also comment on. Sanjay Soni says, there should be additional focus as well on earlier stage startups who have the opportunity to create jobs in peri-urban and less established urban areas. The effect of supporting an entrepreneur who creates 1 to 3 jobs, who in turn supports 3 to 10 families. I think that's a fair point there, Sanjay. And then Blanca says, I've seen many startups in the region having issues with their cap table structure, which leads entrepreneurs to have a lot of dilution in early stage rounds, which is a problem to attract investment when raising in later stages. As investors, I believe we should tackle this by giving entrepreneurs fair terms and educating the ecosystem, which are you're learning on this.
Yeah, so I just quickly, very briefly on that comment, and we see that quite often when the companies, it's difficult raising capital. So you kind of almost have to take terms that beggars can't be choosers in a way. Then you get to a cap table, basically is a technical term for all the investors in the business and who owns the business. So if a business comes to a venture capitalist where 14% is left owned by the founding team, and 86% is owned by a handful of angels and investors that gave unfair terms or unequitable terms. Well, that company has now painted itself in a corner because venture capitalists back founding teams, and they will just say, well, this company is already owned by investors, and what's the motivation in it for the entrepreneur? So maybe taking a bit of a swing at angel investors and stuff, but there are things like safe agreements, and there is more market education, which is a simple agreement for future equity where you don't price and you don't take equity, you just take an instrument which converts at a future point, etc. So there are a lot of instruments that one can use, but investors need to be educated to that point, and it is a nascent ecosystem where there isn't that much experience from an investor space. I mean, Knife Capital's been in it for 12 years. We're still learning. We're updating our process. We're putting new terms in. Now and again, we get. It's like it takes forever. So market education for sure.
To me, I also just wanted to ask, and I agree 100% with Keet. I think it's a question I've been asking myself: why are they so risk averse? That's one of the questions. One of the things I think is probably, if you are to compare yourself to, let's say, United States, the amount of capital that's there is substantial, which inherently means that the level of risk aversiveness is very low lower in comparison to, let's say, us. That being said, doesn't mean that we don't have enough capital. It's just that I think comparing ourselves to a lot more, an ecosystem that's a lot more established is a mistake, right? And then I agree with Keet. I mean, for us, when we're looking at equity and transitioning from our debt fund to an equity fund, normally you look at it and you polarize, either it's debt or equity, and you don't realize there are a number of other instruments in between that are used, like your SAFE, your convertible notes, whatever it may be. And we really realize that in actual fact, the market doesn't seem to really know these things. And we are, as Keet said, we're also just learning as well as we go along.
So,
thank you, Taf. Shelley?
Okay, you're back. I wasn't going to share if you were there, so you're back. But I'll wrap it up. And I think the interesting part was a few things. So for me, when we started this whole SA startup movement, it was termed the SA Startup Act. So people asked us, well, is it going to be an act, or is it going to be modifying provisions that already exist in the ecosystem or already in our, legal framework? So where we're leaning to at the moment is actually just working with what we've got. In other countries, they've actually done a full act, but it goes across a lot of different departments, and to get political buy-in across all those different departments is often pretty tricky. Whereas actually tweaking what we've got and making it more effective for these high growth, high impact startups, we've determined is actually the easier way to go about it. So where it comes to these incentives, they typically sit within National Treasury, especially with tax incentives. But really what the startup movement or the Startup Act is actually looking to do is actually co-create what that would look like. So what I really liked about that as a principle, it's getting all the ecosystem players together with the government policymakers and saying, okay, what problem are we trying to solve? How do we think we can craft this incentive to make it work? And then once you have the ecosystem participants there, they are there to also help make sure that it's practical, it will reach the right people, and government can understand where we're coming from and why we're thinking about it. So just the actual, if you want to call it the venture capitalist or the people that are funders, there's maybe a bit of mistrust or whatever the case may be. But the good thing about the movement is it's across the whole ecosystem. So you want entrepreneurs in the room, you want accelerators, incubators, you want all the people in the ecosystem that can help shape what this actually needs to look like to make it practical and to make it work and to ensure that it goes to the right players. So then you can understand from a policymaker's perspective, this is what they're worried about. This is the framework that they have to work in. And then you're essentially problem solving around that to be able to come up with something as an ecosystem that you all buy into, that you say can work. So I think for me, that's the key, is that it's actually a call to be able to say, how do we put this in place to be able to do it? Because you can write a set of proposals, but either it's not going to work for one person, or the policymakers are going to say, well, we don't have enough money, or whatever the case may be. But if we can try and understand where everybody's coming from and where we are specifically targeting the money to go, we can create around that. And I like that co-creation aspect of it, because I think it's key to actually solving the issue, because it is a very complex issue, and no single party actually knows enough about everybody's mindset and what their issues are in order to solve it on their own. And therefore, the co-creation model is really one that actually resonated in terms of trying to solve it.
Yeah, and I think maybe just a comment on that to give some hope is just from a SAVCA perspective, there is really great engagement with National Treasury, with SARS, with SARB, with so it is really trying to find the right incentives for the right behavior. Because I think the last thing people need is a repeat of the dark side of 12J. We need to foster the good side of 12J as just one example. So that is an example of an incentive that incentivizes private high net worth individuals to put a hell of a lot of money behind startups. Then there's incentives themselves within the startups, which we can also work with tax and treasury and future capital gains tax and those type of things, and just the way people invest in themselves. So startups, if you think about it, usually have to take salary sacrifices and those type of things to just afford their business. Well, there's other ways to do that through first loss funds or grants or certain things which just or technical assistance or really looking at making it just easier to get paid faster. It's basically there's a lot of tweaks around and a lot of it is talked to in the draft paper of the Startup Act to just make sure that capital or money, cash flow goes quicker into businesses, because I think the best way to fund the business is to be revenue funded. So access to markets. How do we get a legislation which is already there around procurement and those things? I mean, South Africa is perfectly set up there because we are trying to procure from small business with point systems and on all the rest of it. But how does one actually just channel those to be more efficient, faster, oil the machine and give the funding into the startups? And how do we get more businesses more interested in buying local? So at the end of the day, I maybe we'll conclude with that, is to say, well, with one of the startups that stood up in a forum like this, is to say, look, all I actually just need is for you guys to buy my flippin' product, and if more of us can just do that, well, that will solve some of the problem.
Yeah. Thank you, Keet, for those remarks. And I like what Taf is saying in the comments. Like, we also have to be very clear on what our definition of success is. And I've been told that I'm only left with 4 minutes. So I'm just going to ask Taf and Shelley to give me briefly what your definition of success would be in terms of this particular recommendation. And also to all of those who are attending, you've got 30 seconds as well. Well, you guys have got 3 minutes to put your comments in the chat box and we'll read those.
Shelley, you want to go first?
Sure. So I think for my definition of success is for us to work out a way to get more capital to flow to these high growth, high impact businesses. End of story. And I think it's everybody has a role to play, and it's to just work out where that sweet spot is, that everybody plays the role at the least cost to the fiscus, and that much more capital is catalyzed to be able to flow, so that we aren't in another 5 years time or 3 years time still talking about the same market failure and what we want to do to fix it.
Yeah, so I think on my end, it's two-pronged. I think I look at it from a demand and a supply perspective. We are starting to make progress in building individuals who are looking at establishing startups, and I think we need to get a lot more of those, and a lot of them being representative of the population in terms of being Black. But at the same time, we know you can't do that in the absence of actually creating a conducive environment for these businesses to actually flourish. Otherwise, we're just creating another problem. So I think it's two-pronged. And if we're able to look at it from both perspectives and create a conducive environment for both parties, demand and supply, I think we'll be making progress. That's my definition of success.
Thank you very much. And on that note, we have reached the end of the webinar. Thank you so much to Keet, Shelley, and Taf for sharing those insights. Thank you to everybody who has joined. I'd just like to remind you and encourage you to continue with this discussion on social media. Twitter, the handle is @SA_StartupAct, and please use the hashtag #SA_StartupAct movement, and also join the movement. Like we've been saying, I said it, Shelley said it, that alone you cannot achieve the impact, but if we rally as a collective, we will be able to see this impact. So please join the movement on, I've posted the link in the chat box, startupact.co.za. Thank you very, very much for everyone, to those who joined us. Enjoy the rest of your evening. Cheers.
Yes.
Cheers. Thanks, everyone.
Thanks to me. Thank you, everyone.
Thank you. Bye. Have a good afternoon.